I have a few focuses in my trading career, and we're going to focus on, in today's presentation, on one of the biggies, which is, I suppose, the big umbrella is technical analysis. So we're going to talk about the most important indicator. Now, guys, I've got my question chat box thingy up. Hopefully I've got the right one up, actually. If I want you guys to be involved in the presentation, ask your questions. I'll be asking you some questions as we go through this, so feel free to berate me and do whatever you want to do, and we can throw some great ideas around. So before we kick off, we've of course got to have the usual risk disclaimer. I won't bore you with the details. I'm sure you've had it enough today. So let me tell you a little more about us before we get into the crux of things today. The presentation is going to be pretty short compared to what you're used to. We're going to focus a lot of the time on the Q&A at the end. So we provide technical research to a lot of professional traders. Some of these guys are examples of people we work with, and we also provide them to individual traders as well. So I started off in the professional space, and we've kind of developed the user base from that point. So moving into we've got actually a team of analysts and traders that work with us and put our research together in the technical space, in the fundamental and news-based space. So we do quite a few. We cover quite a few different areas. So moving on into today's presentation, the big focus for us is what you see on the screen right now, and that is every trade starts as a coin toss. Every trade starts as a coin toss. So guys, that's a question for you guys in the room. What do you think I mean by that when I say every trade starts as a coin toss? Type into the text chat. Let me know what you think I mean by that. And that's a softball for everyone. Okay, we're getting a bunch of answers coming through. Yeah, the odds 50-50, 50-50 chance, absolutely. So essentially, when you describe a coin toss, you're describing, something that has a 50-50 probability of taking place. Now, when you conceptualize a trade idea, whether to go long or to go short, essentially, when you conceptualize that idea, it's 50-50 odds. Literally, as soon as you pull the trigger, the odds of that trade fall against you. Right? Due to spread, due to commissions, due to a variety of different reasons, you're instantly, the probabilities have fallen against you. Now, your job as a trader is to analyze probability. That's what everyone in this room is doing. You are analyzing probability. And because of that, you are all statisticians, whether you realize it or not. So the strategy choices you make, your trade management, whether you keep a journal, all these types of things ultimately are things you're doing to increase your probability and increase your edge and stack the odds in your favor. And you're trying to build what I call a probability tower. You're trying to build these little slivers of probability, and this is I know this is Jenga, but you're trying to build these little slivers of probability on top of each other. So guys, another question to the room now. What adds probability to your trade? What can you do as a trader to put the odds in your favor? So literally, as soon as you pull the trigger, the odds go against you. What can you do as a trader to put the odds in your favor? So what adds probability to your trade? So Hein is trading there with fundamental analysis. Absolutely. Absolutely. Trading with the trend. Yep. Using Fibonacci. Technical analysis. Yep. Absolutely. So keep them coming, guys. What can you do? Trade with momentum. Risk to reward. That's a great one. All of these things that you guys are describing, that you're typing into the text chat right now, these are having a plan, absolutely. These are going to put the odds in your favor, right? That's your sole focus. You want to trade with the trend. All these types of things will put the odds in your favor, and that is the big thing for every trader to try to achieve. It's even little things like whether you work out or not. little things in your lifestyle choices. These can have an impact on your trading ability. They can have an impact on your focus, and that ultimately will have an impact on your edge and your probability in that trade, whether you realize it or not. So there are some things that we can do within our trading plan, and there's other things that are beyond it. Like control. Mahesh just came with controlling your emotions. Absolutely. So all of these things add slivers of probability in it. Your job as a trader is to work out what's adding probability and kind of build up this little tower. That's the best way I think. I think anyone can think about trading is the way is how they are stacking the probability and odds in their favor, and that's exactly how professionals view the market, their strategies, and how they trade. So moving into the main focus of today's presentation, like I said, it's all about stacking probability. Now, I have a massive focus on support and resistance, and the reason why is because this is where trading, starts with me. In my opinion, this is the most simplest form of analysis, and it's something that every trader needs to pay attention to really where the focus on in their trades. So I have kind of a deeper analysis of what support and resistance is, and we'll kind of go through that now. So support and resistance is essentially a technical interpretation of price based upon specific methodologies. These methods provide an indication of market dynamics in terms of supply and demand. Where supply overtakes demand, this is described as resistance, and where demand overtakes supply, this is described as support. The supply and demand dynamic can be interpreted or predicted by methods that can be either proactive or reactive. Now, guys, these are two incredibly important words in the breakdown of technical analysis that we as a company do. So let me break this down for you guys. Now, it sounds kind of a little bit out there and jazzy, but it's very straightforward. In my opinion, and in my research, there are two types of support and resistance analysis. There is proactive support and resistance, and there is reactive support and resistance. Proactive is things like Fibonacci, calculated pivots, Elliott wave. All of these methods are mathematically derived, right? They use what the market actually did, like the highs and the lows or whatever else it might be, and they apply a mathematical formula, and that's how you get these numbers. So market profile, moving averages, trend lines, Elliott wave, this is all a derivative of what price has done. Does that make sense, guys? Give me some yeses in the chat if you're with me so far. So proactive support and resistance is using market information and is a mathematical derivative. Great stuff. Yes is coming through. Excellent. So the flip side of that coin is reactive information. Now, reactive information, lost my mouse. Reactive information is what the market actually did, right? So it's what you'll see on the volume profile. It's the major price swing highs and lows, the initial balance, open gaps, open high low close. These are reactive forms of support and resistance. It's what the market actually did. It's the highs you see on your chart, and this type of thing. With me so far? So proactive is mathematically based, mathematically derived, and reactive is what actually happened, what you're actually seeing on your charts. All right, so yeah, just what I've described there. So just to summarize, proactive information is support and resistance information based upon predictive calculations derived from price, and reactive is support and resistance information based upon direct price and volume action. So any of you guys in here use Fibonacci or Elliott wave or calculated pivots? Type in what you use. And essentially, if you use those, you're a proactive trader. If you're using, price swing highs and lows, volume profile, market volume profile, open gaps, this type of thing, you're a reactive trader. Let's move on to the next slide. So I'm gonna break down the methodology that we employ to essentially find areas of the market to pay attention to. Elizabeth Lightbody just said, I use both. That's a great statement. So you're going to love what we're going to go through now, Elizabeth. So we're going to break down the methodology that we employ, and I'm hoping to give you guys lots of great ideas that you can take away, apply to your own trading, and hopefully it will give you an edge. So the methodology that we employ is quite extensive, it's quite exhaustive. A lot of you guys are going to think this is complete overkill. It's just how we do things, and you know how you choose to do things is up to you. But I'm hoping you'll get some great ideas. So the method breaks down into three main parts. Part one is called technical confluence. Now, this sounds like an out there kind of phrase, but it's very simple. Essentially, what you're doing is using multiple support and resistance methodologies. So those methods that we just went through earlier on, like the fibs and pivots and all these types of things, it's using a lot of those methods together, and we're essentially trying to combine proactive and reactive approaches, just like Elizabeth does. We're trying to combine these two different approaches together with multiple forms of technical analysis. We're basically cross-referencing and comparing these methods to find high probability reversal areas. Why these areas are high probability, we'll kind of break that down as we go through the presentation. But for now, that's a good little summary. Hopefully that makes sense to everyone. So how does this method work? Now guys, this is going to be a gross simplification of what we do on a day-to-day basis, but it's to help illustrate how the method works and how we put our research together. So on this chart, it's probably a 5-minute chart, but the lines you see there are from multiple time frames. So anything from a monthly down to a 5-minute chart. And these blue lines are major price swing highs and lows that you as a trader need to pay attention to. So we've drawn in these major price swing highs and lows. Blue lines, that's that job done. Now, what we do next is include the volume profile analysis. I hope everyone here is familiar with volume profile. If you're not, send us an email and we'll tell you some more about it. It's a great piece of analysis, but essentially it tells you the amount of volume traded at a particular price point. And these red lines here are what's giving us volume information. So these are major peaks and troughs in volume. Major highs and lows in volume happen to coincide with those areas so far. So this is where things start getting a bit interesting and spaghettified. What you're seeing here are the yellow lines are a lot of calculated pivots. So we're talking the Woody's pivot methodology, the standard pivot method, floor pivots. There's a ton of different calculated pivots out there. What we try and do is look for pivot cluster areas. So there's a few areas here where lots of these yellow lines are coming together. That's what we pay attention to. So it's these individual single lines, meh, not so much. But the clusters, the pivot point clusters, are a big deal to us. So moving on through, next into the mix, we're going to throw in some Elliott wave. Again, this is for multiple time frames. So these pink lines here are areas of interest to an Elliottician. Again, a gross simplification just to illustrate the point. Now, what you're going to start to notice is that there are a few areas now where quite a few of these methods are coming together, which is quite interesting. You know, these are different traders, different groups of traders, the Fibonacci users, the Elliott wave users, the calculated pivot users, and we're seeing them come together and confluence with each other. So next into the mix, we're going to throw in some Fibonacci clusters. Now, what we do with fibs is rather than just look at a single retracement and extension, we look at these retracements and extensions across multiple time frames, combine them together, and look for cluster areas, just in the same way that we did with the calculated pivot. So these bright green lines are really high value Fibonacci areas across those multiple time frames. So, you know, you're seeing a bunch of areas here where quite a few methods are coming together. So there's quite a few other methods we look at, like moving averages and this type of thing. And what I've done is thrown those all onto this chart here. So I hope this is making sense, guys. Give me some yeses if you're with me so far. So what we're doing right now, type into the text chat if you're with me so far. What we're doing is combining multiple forms of technical analysis. We're combining multiple market participants, and we're putting them together onto one chart. Right? We're essentially, whoever is trading and viewing the market, we're essentially putting their viewpoint together and cross-referencing and comparing them. Right, do you guys like this? Is this good? Give me some yeses. So this is part one. So part one, even if this is what you take away from today, it's pretty cool, and hopefully gives you guys you know, a bit of an edge. So, all right, next. Now, this is the next two kind of points we're going to break down are areas where a lot of traders seem to stumble. I'm surprised that how few people have actually heard of intermarket correlation. And correlations are incredibly important. They're a very, very important part of trading, and they're something I feel every trader needs to pay attention to. So we're in a global trading marketplace. And what we do at To The Tick is we analyze correlations across a basket of markets, and we like to look for markets that are moving in tandem, i.e. moving together. And we're looking for them to have relationships. Now, these correlations come and go, but we're looking for markets that have strong correlations, that are consistent, and that can offer some corroboration for the technical confidence levels that we've already seen. So I've got a little, does that make sense with the intermarket correlations? It's basically how, you know, how markets move together. So for example, the S&P, the NASDAQ, and the Dow, situation of over 85%. So that means 85% of the time they're moving pretty, you know, the highs that are on the NASDAQ are likely to be the same kind of highs. So it's pretty straightforward once you think about it. Okay, my mouse again. Let's find this. Okay, here we go. So, wrong slide. All right. So now, guys, I've got a little test for you now. So this shows your knowledge of correlation and how easy it can be. Now, on the left we have the stack. On the right we have a chart of the S&P. This is obviously the student same time. What I want to do is, on both these charts, again, very simplified, we have some technical confluence areas, right? These are the best areas to pay attention to. What I want you guys to do is help me make some pairings, right? So we're going to compare the 1, 2, 3s with the A, B, C, D, E's on the NASDAQ side of things, on the S&P side of things. And I want to make some pairings. So which two confluence areas kind of corroborate it with each other? Is it 1 in B? Is it 2 in C? Is it 3 in E? If you could type into the text chat and let me know which of these are correlating with each other, which ones are kind of fixing together. All right, so Marty's throw it in there with 1 in A, absolutely. So 1 in A, we're seeing a strong correlation. We've got this technical confluence area, that's the high on the NASDAQ, and we've got a technical confluence area, that's a high on the S&P. Okay. And again, yep, 2 and B, absolutely. A nice correlation there. So technical confluence area 2 and technical confluence area B. So these two markets are kind of coming together. And with 3, we have 3 and D. Good stuff. Well done. Some great answers coming in. No one's getting this wrong. And this essentially means that you guys have an understanding of intermarket correlation. That's essentially what we're talking about here. When you apply it to technical analysis, is we're looking for markets that are correlated, that have confluence areas, and that those corroborate with the confluence areas of the markets that they're correlated with. With me, guys? Give me some yeses. Does that make sense? So what we can do now is eliminate these confluence areas that are not particularly great, that don't have that, you know, increase in probability to give us that edge. Excellent, guys. So great stuff. You're all with me so far. Good stuff. Okay, so what else? What do we do next? Now, I'm hoping you guys find this really interesting because I've spent a huge amount of time analyzing market statistics to come up with the ideas and what we do right now. I'm just going to get a quick glass of water. Okay, so what I've kind of in my analysis, and this is well-known information, that the market tends to move through certain phases, right? On the whole, the market goes through an accumulation phase. We then see a markup, we see distribution, markdown, and back into accumulation. Now this is like the cyclical nature of the market, the waves that we tend to see in the market. What I found, and this is true for technical analysis, this is true for the system or methodology that you employ, is that the methods that we use in the market are dependent upon the phase that the market is in. So for example, you've developed a system, you're using that system on the sim, and I'm sure a lot of you guys in here have probably experienced this, and it's doing really well. You know, you're making a ton of money, everything's working out great. And then you decide to move over to the live market, and it probably goes well for a couple of weeks, and then suddenly things start to fall apart. Some of that may be due to psychology, but many of the times it can be because the market phase has changed. We've gone from accumulation to markup, and your system is not adapting. Your system is not evolving, your methodology is not evolving with the market. And we see it day in, day out, month in, month out, where a method that we may have used a little while ago is not working at all now. And the perfect example, I don't know if anyone has come across the turtle traders who were trained by a guru in the 80s, and this was a method that made millions upon millions over the years. And if you had applied that same methodology, this is a really, really famous group of traders, lay people that were trained up. If you had applied that same methodology over the last 15 to 20 years, you would have lost money hand over fist. It's just a different environment, and that system is has not been able to adapt to how the market has changed. Now, the point I'm making with this is systems are unable to adapt, and technical analysis methods are also unable to consistently adapt. So you'll see in an accumulation phase, for example, that volume profile might work incredibly well and Fibonacci less so, and in a markup phase that the fibs work really well and volume profile and some of the other methods less so. There is not one consistent method that I have found, consistent technical analysis method that I found that works all the time. It just doesn't exist. There are some that consistently work better than others, but there is not one single method that works throughout the time. Now, what I've been doing is basically figuring out in which phases which methods work better than others, and giving those methods a statistical weighting as part of that technical confluence. Right? So if we know that in a markup environment that fibs do really well, and that another form of analysis doesn't do so well, we can then give that a rating out. Let's just say, for example, it's out of 10. So we know that fibs are really strong, they get a 10 out of 10. Volume profile is really weak, it gets a 1 out of 10. And what we do is the confluence areas that we spoke about earlier, say we have a confluence area that has 2 methods and a confluence area that has 5. Right? You remember the confluence areas? We may have an area that has only 2 confluences, but those 2 confluences might be the most statistically viable for that environment. They might be a 10 and a 9, and these might be 1s and 2s. And because of that, we are more likely to choose an area that has only 2 confluences because of that statistical viability due to the phase that the market is in. Does that make sense, guys? This is probably the most difficult part of what we do to understand. So give me some yeses if you're with me so far. I can try and explain it a bit deeper. But what we're essentially doing here is analyzing these different methods, the fibs, the volume profiles, these different types of things, giving them statistical weighting, and then making sure that we have the best confluence areas in our analysis. And let me move on to the next slide. Okay, so what we also do is look at whether the market's bullish or bearish, whether we're trending or ranging, high volatility, low volatility, and various combinations of all of these. And these descriptions give us a description of what, these descriptions give us an indication of what the market's personality is. And the personality describes what methods we use and what methods work best. Right? And we can use things like the tick and the trend and all these types of things to help us gauge this information and break it down for us. So we're paying a lot of attention to give us that information to internal market gauges like daily ranges, the tick, the trend, these types of things. We're analyzing and consistently trying to analyze how the market is changing, how the market is evolving, and this evolution is what keeps you on top of the market. Does this make sense to you guys? How this type of method, where you're constantly paying attention to the phase that the market is in, how it can help you evolve with how the market is changing. Does that make sense to everyone? Give me some yeses. It's all about that. It's a very important thing to be able to consistently adapt. It's a very, very important part of trading. So once you've done all that research, you end up with what we call the power zones, these blinding red zones that you see in the chart right now. With our research, we cover 25 different markets. This is what we cover on the FX side, and this is what we cover on the futures, so the S&P, NASDAQ, etc. Guys, if there's any questions, feel free to ask away. I don't have a paid offer or anything for you guys today. I just want to introduce tothetick.com/free, where you can get free, completely free daily access to our To The Tick Lite product, which is a light version, of course, of our premium product, and it contains all the fib clusters and pivot points and market profiles. So if you go to tothetick.com/free, you'll be able to sign up to that, and it will be sent to you on a daily basis for all of the different markets that we cover, which are these 25 different markets, all the futures and the FX side of things. So guys, keep those questions coming, and I'll be happy to answer them. So Mahesh is straight in. Will this strategy work on any time frame and any instrument? Absolutely, Mahesh. It really depends on the time frames that you're focusing on. So if you were to apply this type of research, you could pretty much use it however you wanted. So whether you're trading incredibly short term, that's what we focus on, which is the day trading based information, but a lot of people use our research for intraday trading as well. So you could certainly do that if you want to do that. Janko is asking, what's my name and email? My name's Aamar, and my email address is, the best email to get me on is support@tothetick.com. Mahesh is asking, on what platform will the indicators work? The URL's not working. Let me double check that. To the tick. It is working. It just seems like there's a lot of people going to the website at the moment, and it's just running a bit slow. That's all it is. This is what you should see. So tothetick.com, tothetick.com/free, and you'll be able to get everything from there. Mahesh, on our premium research works on all the major platforms. So you can have the Power Zone research that we provide on all the major platforms. So we're talking about TradeStation, NinjaTrader, MT4. We also cover Thinkorswim. We have multi-charts. We have Sierra or Infinity. There's a few others as well that they're just not springing to mind. Ensyn. So we cover all the major platforms that are used with our premium research. What we're talking about here with the Lite, this is just a daily data sheet that we provide for free as part of our research that you can get hold of. So you can get that from there. So guys, keep those questions coming. The methodology, do we provide any advanced education? We provide education on what you see here. What we don't do is give you information on how to trade our research. And the reason why is because our research, we're a research provider. You can essentially apply the levels and the zones that we put out there to any method you want. That's the beauty of it. So whether you're a short-term trader or a longer-term trader, whether you're looking for breakouts or you're looking for reversals, you can use our research to basically give you an edge. That's the key thing. And no worries, Mahesh. But by all means, guys, it's completely free of charge. tothetick.com/free. You're most welcome to sign up. The method that we use, it's quite exhaustive, but the light version, you're getting some cool stuff. We've got a breakdown of the COT index as well. So the Commitment of Traders report that comes out on a weekly basis, we provide our kind of version of that. That is kind of like a traffic light system. So you see here it's in red, which is an indication that the traders of the market has shifted to a more bearish stance, which is surprising considering the trend is completely green. But this is how the Commitment of Traders are positioned. We've got obviously the open high-low summary. We've got some Fibonacci clusters. We've got the pivot points, the monthly, weekly, daily floor pivots, DMARC pivots, and we also have the volume and time price opportunity market profile value areas. So the value area high, point of control, value area low. We've got a little rundown of the news that you need to pay attention to. And this is pretty cool. It's called the indicator map, or IMAP. And it gives you a little traffic light view of how these different indicators are positioned. So this is the CCI, the MACD, the stochastics, RSI. It just gives you a quick view of what they do. Gary's asking, how long have I been using this system? This is not a system per se. It's a research methodology, and I've been doing my research this way since about 2006, 2007, which is when I first started putting the methodology together, and I've been using it consistently and developing it since that time. But what we have today, it's completely free. So tothetick.com/free, you'll be able to sign up for the light version. Mahesh just asked a great question. Do I trade? Absolutely, Mahesh. I've traded professionally, and I also trade for myself. So I definitely do trade. It's funny that you don't often get that question, but I most certainly do. For me, the focus has been the technical side of things, and I also trade events. So I do quite a bit of news trading using options, and we did do a lot more on FX a few years ago, but that's just become more difficult. But we do quite a bit of news trading, event-based trading, trading stocks and events, and that type of thing as well. Absolutely. Absolutely, Gary. And we're a research provider. We don't train. We don't teach people how to trade. We simply provide the research that we use for our own trading and have managed to make a business out of that as a focus. That's the key of what we do. I don't know if anyone here is familiar with financialjuice.com. That's where I have my news site and where we do a lot of stuff. So by all means, do check that out. It's a completely free voice news platform, so you can listen to what's moving the markets and get some insight there. And obviously, To The Tick is our technical analysis research. Great stuff, Gary. It's nice that we use our research for it. Absolutely. I mean, that's what it's all born out of. That's where it comes from. Okay, guys, I'm just gonna so hopefully today everything. Oh, here we go. Some more questions coming in. Do you focus on these forex pairs for a reason, or can it work on others as well? The forex pairs that we cover are quite extensive. These are the ones that we provide paid research for. So if you wanted to sign up to our service, the premium version of our service, these are the ones that you can sign up for. But absolutely, you've got a recording of the methodology. If you want to apply it to, do your own research, you can most certainly do it for anything, anything you want. It's that simple. The free version of our research, you'll have the research for all of this stuff as well. You'll have all of these 25 markets. It just won't have the power zones, where we combine the different methods together with the intermarket correlation and the statistics work. It won't have that, but it will have, some of the things to pay attention to. And this this little big white space here, this is where we would normally put the power zones. That's kind of there as a trade journaling area, so you can squiggle in, you know, your ideas and this type of thing. Oh, yeah, absolutely, Marty. So what we went through is the paid research, is our premium research, the methodology that I described to come up with the power zones. That's what we charge for as a product. But you know, I wanted to give you guys something free that you know, it's still offering you an immense amount of value, and that's what To The Tick like. So .com/free for that. Hi, Meher. You give real-time alerts when to enter and exit. No, we don't do that at all. And I've really any provider that offers that type of service and does, and you can do well with it, other than having a live room. So we focus on providing research, you know, just support and resistance levels that you can pay attention to. Hi, JT. Do we have a trading room, tradeless? No, we don't. We don't. We're a research provider. We're primarily a research provider, and when it's trading time, if I'm completely honest with you, I'd rather focus on my own charts and making my own money rather than having to worry about sending out alerts to other traders. I don't know how a lot of these guys do that. It must be pretty tough. Excellent, guys. So we're going to wrap things. We're going to wrap things up, and you know, we're going to call it a day. Hey, Michael, if you don't mind, I can show how to use the zones with my technique. Hey, absolutely, Michael. By all means, go for it. So Michael Sullivan's going to be presenting next, and he'll be sharing some ideas on how to use the zones. So I think that'll be good for everyone.